Bill, thanks a million for being willing to do this. As I mentioned to you, our project on the future of the global financial system is designed to raise some of the really big issues in the global financial system that are likely to be really key over the next decade or so. Realizing, of course, that this is very uncertain territory, and that what a lot of experts might say today, they very well may revise on the basis of new evidence and new research. And I want to, for the sake of this interview, because you've been so broad in the areas that you've worked in and the research that you've done, the presentations you've made, I'd like to just hypothesize that someone, or let's say the G20, has asked you to chair a group that would look at the future of the global financial system, let's say a decade out, and that before you really embarked on this work, you needed to narrow the field down to several questions. And I'm going to pose those questions and see where you think some of the right answers are, again, recognizing that nobody has a monopoly on the truth here. So my first question would be really to look at the global environment for finance, for monetary issues over the next decade, and maybe to try to identify some of the areas that could be real game changers. And just as an order of magnitude, I would say, and I think your papers say, that if you were to look back over the last couple of decades, the rise of several developing countries to the center of the global economy is a kind of game changer. And I'm just wondering, if you were to look ahead, is what on a major order of magnitude could we possibly see that would influence the shape and the conduct of the financial system?
I think one of the most important things to come down the road is it's a train that's already sort of left the station, and that is re-regulation. We have long swings in this area, as you were well aware. Before the Great Depression, there really was a highly liberalized system. Then we got the Great Depression, and then for various reasons we had a real process of re-regulation that went on for 20 years. And then the system gradually became more liberalized again, and it got liberalized to a point that, of course, I think it contributed in a material way to the crisis. And of course, since the crisis, as you know, there's just been an enormous effort of so many people going into the area of which areas need to be re-regulated. And the faith that we used to have, I guess, into the efficiency of liberalized markets, and particularly the efficiency of financial markets, that faith is now gone. And I think for the next 15, 20 years, because these things are long cycles, we are going to be living with the consequences of what the regulators are doing at the moment. That's going to be a really big change. And we're not going to go back for a long time to the kind of world that we had before. This may or may not succeed in achieving the objectives that people want it to achieve. But one of the things that I think we can be sure of is that there's going to be an awful lot of unexpected consequences that will be the byproduct of much of this new regulation. And those consequences will emerge only over the course of 10 years or 15 years. And the reason why I say that is because all policy always has unexpected consequences.
Right.
But this stuff, it seems to me, has been rushed through so rapidly. Think about the length of Dodd-Frank, for example, and the number of pages where it simply says the regulators will have to sort it out. There will be a lot of unexpected consequences. And some of them may not be quite to the liking of the people who brought in the regulations. The analytical framework is inadequate, I think. A lot of the legislation strikes me as being angry, punitive almost, which doesn't make for good regulation or legislation. So I think in the advanced market economies, and let me really lay emphasis on this, in the advanced market economies, it seems to me that this phase of enhanced regulation and maybe even financial repression, we can come back to that later on, may be core to what we're going to see going forward. Now, the funny thing about it, but I guess sort of all aspects of life, it's a question of finding the proper balance. Right. If there's going to be less liberalized financial markets in the advanced market economies, I think there's going to be a significant move towards deregulation in many of the emerging market economies. And there, I think the biggest game changer is going to be in China. Because China has had a highly repressed financial system. One of its primary purposes has been to ensure that consumers don't have the wherewithal to consume, so that the resources can be directed towards investment, and in particular, investment by the SOEs, the state-owned enterprises, most of which are run by the party members. The party seems to be convinced that that really has to change in a fundamental way. They've got to move to a consumer-driven growth model. And one of the things that will have to happen is that there will have to be a freeing up of the financial repression, which has kept interest rates for consumers and depositors extremely low. So that will be a big game changer, and it will have not just regulatory but macroeconomic implications, capital flows, and all this kind of stuff. I think the Indians are going to have to go the same route because it's becoming clearer and clearer that their system is not providing the results that they want. I think they're just starting to recognize that this downturn is not temporary, cyclical, but there's something deeper here, and they need more structural reform, particularly on the financial side. So those are issues having to do with financial regulation or deregulation, I think is going to be the number one thing going forward. I think another big thing going forward has to do with technology. I have been much taken, although I've not spent much time working on it, on these questions of inclusion in the financial sector. And we know that there's just millions and millions, billions of people probably, who have access neither to information nor to financial services. And now the technology is really starting to change that. So you get an Indian farmer, for example, who previously was forced to sell his stuff to a middleman without him knowing what price the middleman was getting for it. And he was getting, roundly, I was going to use a bad word, but clearly this is not an ideal situation. You can't borrow money at let's call market-driven or appropriate rates of interest, and so people have to go to money lenders and become indebted forever. Well, now with mobile phones and finance services apps on them, this apparently is changing enormously rapidly, and that's just bound to have incredible implications, and mostly good ones too, I think, at least for inclusive growth and probably for growth too. And the last big change, I think...
Before we get to the last one, let me just ask you about the second one. Well, actually, I'm going to ask you about each of the two that you raised. What is the implication, or what is the potential implication when you talk about regulation, of more regulation in the advanced economies, less regulation in some of the bigger emerging markets, in a global system? Are you implying that they're kind of going to meet in the middle, or are you painting a picture of a very fractional regulatory system overlaying on a global economy, on a global financial system where the money flows, quite freely across borders? I'm trying to figure out not whether you're right, but what does it mean?
Well, for a starter, there will be an element of convergence in these national regulatory systems. It seems to me that's what I'm saying, which is, as it were, good for international cooperation and for a more general convergence. Precisely how it will happen, I mean, when you think about two things coming together like that, you know, it can be a husband and wife coming together for a tender embrace, or it can be a couple of sumo wrestlers.
Right.
And frankly, I'm not sure how this whole thing will play out. Clearly, one of the things that we are observing at the moment is that there is a growing concern about the divergences between countries. And I'm thinking now particularly the advanced market economies, a divergence in terms of what it is that they're doing that many people find a bit worrisome. Not least, of course, the banks and the financial institutions that have to work with 10, 15, 20 different regulatory apparatuses. And so even if in the longer run we're going to find something closer to a global convergence, I don't think it's going to be a very straightforward process.
Okay. And the second question relating to technology and the inclusion of so many more people, would you say that one of the implications here is, in a sense, a bigger financial system, a bigger global financial system, because these people now enter the mainstream, so the system becomes, in a sense, more robust, but it also becomes more complex because you're now encompassing more and more people of much different circumstance?
Yes, but the kind of services that we're talking about, at least in the first instance, are, it seems to me, more likely to be of the rather simple utility type than the complexity that I think we've in recent years been used to thinking about, which is the complexity of sort of CDOs and CDO squareds and all that kind of subprime and shadow banking stuff. So I don't see this as making the system more fragile inherently. I think probably it would make it more robust, if anything.
Okay. So go on to your third. You were going to talk about a third.
Well, the third one, I mean, is much more speculative, but it has to do with climate change. And assuming that climate change is real, I am assuming it's real, we've got two choices. We either take steps to stop it from happening, or we learn to live with it. But either way, it is going to be enormously capital intensive. And we're going to need an awful lot more saving and an awful lot more capital and an awful lot more longer term investment directed towards those particular objectives. And the difficulty, as we know, is that if there's one thing you can say about the financial system, it's we're in here for the short-term gains.
Right.
And somehow we've got to find a way of developing financial instruments, and I certainly personally couldn't do this, but use what we know about financial engineering to develop some longer-term financial instruments that will be of real interest to the people who like to make longer-term investments, like the pension funds and the insurance companies and whatever, that they can get a proper balance, as it were, of the returns that they need and a reasonable degree of certainty or absence of risk about taking on some of these longer term instruments. So that, I think, is another sort of big challenge coming down the road.
Okay, that's great. That's a great framework. Let me now go to the second question I wanted to ask you in this hypothetical situation of you're trying to guide a committee. Let's talk about the philosophy underlying the financial system, and particularly the 2 or 3 big questions on which you think there is a real legitimate debate. But I'm just going to press you to tell us your instinct as to or where you come down, at least today, on which side of those questions.
Well, when you're thinking about sort of regulating or maybe more broadly, governing, okay? You're thinking about the good governance of the financial system. What are the three big issues? I guess the first issue that I would identify would the importance of having clarity about what it is that you're trying to achieve. Okay. What is the objective of the governance process? And I guess my sense of it would be that, again, it's the balance, is that what we're after is a financial system that supports economic growth, but does so in a reasonably safe way, you know, so that it's sort of the macro equivalent of, I would choose RAROC, you know, risk-adjusted return on equity as an objective rather than just the return on equity, you know, right. Damn the torpedoes and full speed ahead. So I don't want a system in which there's, financial repression, because that's perfectly safe but not very efficient. And you don't want a system where it's full speed ahead. You want some combination of the two. And that, of course, also implies that you have to have some knowledge as well about the kind of trade-offs that you think are acceptable. So this goes back to was it Will Peters, who said, if you don't know where you're going, you're going to wind up someplace else. So I think clarity about the objectives is very, very important. I think a second issue is we want to be clear about what we think are the principal threats to achieving the objectives. And I think as we sort of look both, as we look at history and as we look forward, it seems to me there's two principal threats that one could identify. One of them is complexity. And this is what I've sometimes referred to as the school of what is different. You know, how did we get into the crisis? Well, it was because we had all of these complex instruments and nobody really understood them and people made mistakes. Okay, so that's one side of it. And there's an element of truth in that. But there's a second sort of school, what I often call to is the school of what is the same, which is, well, yeah, we had all those things that were different, but underlying it all really was property. And property, if you go back in history, figures so centrally in virtually all of the big crises that we've had, you know, where people become irrationally exuberant about prices. And then the crisis is on. Now, identifying those two things clearly as the problem, it is important to recognize that there are different problems with different solutions. Okay, so the question is, what do you do about complexity? You know, we have this massive, probably the most complex system that mankind has ever devised, you know, the modern financial system. And the question is, what can you say about those systems? Well, those complex systems, like all complex systems, and there's, you know, a whole science on this stuff now, they break down on a regular basis, according to a power law. There's no way you can predict when they're going to break down. And there seems to be no relationship between the trigger and sort of the magnitude of the crisis itself. These things are all basically unknowable. So what do you do? One way people have been cutting into it, and I personally have got a lot of sympathy for it, is sort of the Volcker, Lincoln, Vickers approach. You know, in the US, Europe, and the UK respectively, which basically says a lot of the danger arising from the complexity has to do with trading and sort of non-utility functions carried out by financial firms. And the answer then is to ring fence them and to make sure that the interdependencies are limited. And I think there's a lot to be said for that. The second approach is basically to say, well, we just have to live with it. And then the question becomes, well, how would you do that? And I think, drawing lessons from other complex systems, like, let's say, forest management, okay? You say things like, well, there is actually stuff we can do to make things better. I mean, one of them is to take full-hearted note of the fact that we've got a systemic problem here, that it's the interdependencies between the bits that are really every bit as important as the health of the bits themselves. So once you look at it that way, I think you can make a lot of progress. A lot of work being done now in getting more data about where the risks are building up, counterparty exposures, things of that nature. And I think that technology, again, sort of allows us to do some stuff that would have been impossible 10 or 15 years ago. So I think that's going to be very, very helpful. I think the recognition that much of what passes for risk management, where you're basically saying, I know the probability distribution of the sort of the profits and the losses, the recognition that that's not true, that in these complex systems you're faced with uncertainty and not risk, I think is another humbling kind of step forward, that you know how little you know. And the last thing, and this comes from Andy Haldane at the Bank of England, I think he makes a very valid point with complex systems, that it is not at all clear that more complex regulation is the proper answer, and that maybe we have to think in a different way. So there are answers to the complexity problem, but I'm not suggesting that any one of them is a magic bullet, and probably we're going to have to crack away at all of it. The property thing is in a way much simpler, right. And there's whole sets of empirical models, some of which have been calculated by my ex-colleague Claudio Borio at the BIS, where you can get very good results linking up crises to the previous buildup of credit and deviations of property prices from sort of underlying trends. So the two big threats, I guess, complexity on the one hand, property on the other, and there are ways to deal with both of them. But I guess that leads me on to my third point.
Well, just on that point, would I be right in reading between the lines here that where you come out is that we have to look at both of these simultaneously, or put it another way, there's no inconsistency between trying to come to grips with complexity and how you deal with it, and also making a special effort on property collateral, which is kind of indisputable that's always part of these crises. That they're not mutually exclusive, right?
No, absolutely not.
Okay.
And I guess I've always had a kind of an aversion. I mean, this goes back 30 years when I was a graduate student, really, looking about the rules versus discretion. And my reaction was always, why does it have to be either or? Right. I mean, why can't it be a combination of the two in a world in which you're very uncertain about outcomes? Okay.
I'm sorry, you were going to go to a third point.
Well, I think I just almost automatically did, I guess, which is, item number one, clear about your objectives. Item number two, be clear about the threats to your objectives and have concrete measures to deal with them. The third thing is to basically accept the fact that everything that you're going to do or everything that you think you know could well be untrue. This brings us back, to Hayek's Nobel lecture in 1974, which he called the pretense of knowledge. Right. The idea that I've got this one figured out. All of history teaches us that we don't, and we're constantly making mistakes. And so what do you do about that? Well, my first reaction is to say, don't put all your eggs in one basket. So when we start thinking here about the governance of the financial system, the disciplining of the financial system, much of what we've been talking about has to do with regulatory stuff. And I guess that's sort of where all the action has been, is regulatory stuff. And I want to suggest, I think, that we really need to put more effort into other ways of disciplining the system. One reason for that being that regulatory stuff has got a lot of downsides. One, it does interfere with growth, okay, so with what we were talking about before, with one of the objectives that you're trying to achieve. I think, too, one of the problems with regulation, I'm certainly not the first to say this, is that the regulation itself induces distortions in the system. And if the system is not just a complex system, but a complex adaptive system in which all the agents are alive and trying to make money, then you're going to do what you do and open up some opportunity for them, and they're going to run for the profits. And then you're going to have a whole series of new regulations to deal with the way in which they circumvented the old regulations. And this can go on forever in an enormously unhealthy way. So there's a lot of downsides to regulation. We should keep that clearly in mind. So what are you going to do then if you're not so keen on regulation as a discipline? Then I would say you need more market discipline, and you need more personal discipline, if you want to put it that way. The market discipline, more transparency is going to help. And I think a lot of people have been sort of pursuing that. Not always very successfully, because, of course, a lot of the money is to be made in the, in the shadows, right? It's the rents that people get from having sort of things that are not sort of commodities. That's where the money comes from. And so people are really keen on keeping the secrecy. But I think we should make a big effort in that direction regardless. The other side is basically what comes down to self-discipline. And I just came back actually from making a presentation in Canada, and the Canadians tend to be pretty, kind-hearted folk.
Right. So
one of the things that they put a lot of emphasis on was, and I agree with them, is whatever happened to fiduciary responsibility? That if you're in the financial system, years ago, your idea was that you were there to protect the interests of your client. Well, we've got to get more of that stuff on the table, it seems to me. So I think that would be a very good thing to do. Again, in terms of self-discipline, I think altered pay incentives are another big thing, and a lot of progress is being made on that front. I noticed Fidelity the other day, investments, just came down pretty hard on many of the companies that they invest in, basically saying that your pay incentives have got to be better than the pay incentives that induce people to go for longer term investments, that's got to be improved. And lastly, well, not quite lastly, in terms of self-discipline, I think that more people have to go to prison. And I was shocked, frankly. I mean, in the light of this crisis, when you compare it to the end of the S&L thing, the paucity of the number of people that have actually been criminally charged, I think we need more of that. But the most important thing of all in terms of self-discipline, and it's not going to be easy to do, is we need much less safety net for financial institutions and for financial markets. And the safety net is the thing that induces people to say, I can go for the upside and somebody else will pay for the downside. And that's something that's very important that we do something about. It's absolutely fundamental, it seems to me. Indeed, some people would say, I wouldn't go that far, but if you got rid of this, if you got rid of the safety nets, you brought back self-discipline, reprivatized all these companies and gave them unlimited liability, you wouldn't have to do anything else.
Let me move to central banking now. I'm less interested in what's happening right now, but we can't ignore that. The central banks are really on uncharted territory in terms of the role that they've been playing, the amount of liquidity they have been injecting into the system. Let me ask you about this. You have very eloquently written that monetary policy is a function of the political, historical, economic framework of the time. But if you hypothesize this world that you are talking about of much more regulation, a world in which there are many more people included in the financial system, a world where there really is an effort to come to grips with the vulnerabilities of the system, yet continue the growth engines. What are the fault lines now for central banking? What is the dramatic question in terms of what central banking might be like, several years from now, in terms of the roles that the central banks would play, the instruments that they would use, and maybe above all, how independent will they be, and what will be their links to governments?
Yeah. Well, let's start off with that great line from The Wizard of Oz. Toto, we're not in Kansas anymore. Right. I think the central bankers in the decade or more prior to the crisis lived in such a wonderfully easy world where they had one objective, which was price stability, and they basically had one instrument, which is their short-term interest rate, and they pulled the one and they got the other, or so they believed. And they did believe for a long period of time that not only was price stability required for broader macro stability, stable growth and low unemployment, etc., but somehow that belief that it was necessary morphed, and honest to goodness, I have no idea how this happened. It morphed into the idea that if you had price stability, you would get macro stability. And how they could have believed that, frankly, I have no idea, because if you go back in history, there was no big inflation prior to the Great Depression. There was no great inflation in Japan prior to the Japanese crisis. There was no inflation in Southeast Asia. So, just as an historical fact, how they could have believed that beats me. But they did believe it, and now they can't believe it anymore, because we've had the crisis and it's clear that price stability is not sufficient. So where do we go from here? The first thing is that the central banker's life is going to get a lot more complicated. And there's going to be a lot more interference from governments. And this raises the question of independence. And there's a large number of elements that are going to play into this over the course of the next little while. One of them, I guess, is that in the course of this downturn, the central banks have been forced to do a lot of things that have got distributional implications. Lehman's died, AIG lived, this kind of thing. Somebody's got acceptable collateral, somebody doesn't have acceptable collateral. Distributional issues are archetypally political, and the central banks have gotten drawn further and further into it. Second thing, and it has to do still with the distributional stuff, is that many governments have got sovereign debts that are now at a level that they will be very hard to service at normal interest rates. And there will be an enormous amount of pressure on the central banks to keep the interest rates low. And of course, this has important distributional implications too, because what it means is the debtors are going to gain at the expense of the creditors. For the first time in my life, I'm a creditor, and I don't like it. That's the second thing. Third thing is that the central banks are going to get involved with the question of financial stability, whether they like it or not. And on the one hand, they may be given a mandate for financial stability to go along with price stability, in which case they're obviously right in it. But even in instances where they're not given a mandate, okay, for financial stability, and there's many people who would recommend that they not be given a mandate for financial stability, they're still going to have to cooperate closely with those who are responsible for financial stability, because the instruments that each of them are using interfere with the objectives of the other party. So that if you're, let's say there's a separate financial stability group, okay, they're going to be moving around their financial stability or macroprudential instruments in ways, loan-to-value ratios, let's say, which will have implications for asset prices and for inflation more generally. And if the central bank is changing interest rates in the interest of even solely price stability, it's going to have a big impact on financial stability. And there's all sorts of evidence to indicate that interest rates have got a big impact on, the level of interest rates has got a big impact on people's willingness to take risks. And so, come hell or high water, we now see we have a world in which that simple central banker's life is just not going to continue. So, where do we go from here? All I can say is at the systemic level, in terms of governments, as it were, mustering their resources to deal with problems of systemic instability in the financial system, there's absolutely no agreement anywhere about what's the best way to do it. So when you look at what the Europeans are doing, where they've got this, is it the Financial Stability Oversight? I never keep the name straight, but it's chaired by the president of the central bank, but it's got the presidents of other central banks and the chief supervisors on it. In the United States, you've got a completely different approach to it, with the Secretary of the Treasury being in charge of this committee. The Japanese, they've got a completely separate unit that's not supposed, that basically says, we'll do everything. But yet the Bank of Japan has got these two perspectives, one of which is short-term inflationary developments, but the second one is let's not let the 80s happen again. So they've got two inconsistent sort of, and in the UK, you've got the governor of the Bank of England, who's chairman of both the Monetary Policy Committee and the Financial Policy Committee. I guess personally, I think that last model is probably better than the alternatives, frankly.
That's a model that puts the central bank in the center, right?
Yes, puts the central bank in the center. For various reasons, I think it's probably by no means ideal. You can still imagine those two committees sort of fighting each other to the death in the way that I was talking about the two separate organizations, the central bank and the other doing so. But I think the central bankers, although they certainly didn't exercise these powers very vigorously leading up to the crisis, I think are more used to thinking in systemic terms than the traditional regulators are. They've got a more top-down approach as opposed to the bottom-up approach. And I think, too, with respect to either monetary policy or macroprudential leaning against emerging problems, you're really taking away the punch bowl. I mean, what you're saying is we need somebody who's got a tradition of independent action and the courage to do what's going to be very unpleasant to an awful lot of people. And a central bank might be the better place to start. Anyway, I guess the only point I want to make is that there's still a huge divergence of views about this whole range of territory. And I think in certain respects there may be conflicts between political and economic objectives here. So there's no right answer again.
Right. Let me ask you a final question, and this is from a global perspective. You've been talking about a lot of things which there's an undercurrent of lots of different approaches around the world and lots of different conditions, but we are dealing with one financial system, ultimately. So when Bretton Woods was created, there was at least the illusion that there was one institution at the center, and that was the IMF. And while it never quite worked out that way for a lot of reasons, including the dispreponderant power of the United States, we're certainly moving into an era where there's much more multipolar structure, and we've got a lot of institutions. And as you've so eloquently said, we've got a lot of different approaches and a lot of big questions on which there's no agreement. Do you feel that there is any utility in trying to centralize more the analysis and the decisions and the enforcement, or are we basically destined to have a what you have called in another context a non-system for as far as we can see? From a global perspective, how should we think about that question? More institutional centralization, or impossible, and maybe even undesirable?
Well, I guess on the basis of everything that I've seen over the course of the last 30 or 40 years, this is not going to be possible. Let's talk first about the international financial system, which I think has to do with the regulation of globally active firms and globally integrated markets, and then spend a couple of minutes later on what I would call the international monetary system, or the exchange rate system.
Okay.
And both of these things are both important and difficult. In terms of the international financial system and sort of global regulation, I think the way that they've decided to do it, which is essentially set up outfits like the FSB and the Basel Committee, is probably the only way that really will allow us to move forward. And what it does is it essentially says, let's all agree on some common principles as best we can about how to do this. And then let's everybody have a bash at trying to implement them. And then let's constantly keep looking over each other's shoulders through peer review and the rest of it to see that people are staying honest and not just pursuing their own national goals. I think that's about as good as we're going to get. And clearly, there's a lot of difficulties with it. You need a lot of peer review, and it's difficult, but it's better than I wouldn't say it's better than the alternative. The alternative is not possible. The alternative would be some kind of a super regulator who had powers, right? Had powers to actually go in there and discipline people and make them do what they were supposed to do. This is not going to happen. Now, I'll probably be proved wrong 5 years down the road, but on the basis of everything I've seen, the countries guard their sovereignty in this area so jealously that it's hard for me to imagine huge steps forward being taken. And I use the example of Europe. Okay, now I've just finished Harold James's book about the beginnings of the introduction of the euro. And people back in the 1980s were saying that banking union was something that was absolutely central to making the whole thing work. And here we are, we had a speech last June that basically said, oh, I think that'd be a good idea. And then they've started to implement it on the basis of banking supervision first, as opposed to banking resolution and deposit insurance, because of their concerns about the loss of sovereignty and the loss of national money. Right. So, all those years and so little progress has been made. So at the global level, forget it. But having said that, I mean, if they really keep at it, they can make the soft law approach of the FSB and the Basel Committee work. The next element of it is the international monetary system, which really has to do with exchange rate relationships. And there too, I think there's been a really sort of since the breakdown of Bretton Woods, there have been developments which have, in my judgment, have been the fundamental variables responsible for the crisis that started and that still afflicts us. Now, what do I mean by that? The NUN system that we had, basically the advanced market economies, whenever they got into any trouble, the US most of all, but the others as well, whenever they got into any trouble, because investment was collapsing or because there were fears of a financial sector problem or whatever, the answer was print the money and lower the interest rates. Now, what that should have done, and I mean, this all started 20 or 30 years ago, if not longer, but just think about the last cycle since 2002, okay, to the low interest rates in 2003, and then the gentle increase, and then the collapse subsequently. You sort of think about that period. The answer all the way through has been get the interest rates down, QE2, whatever, print the money. That should have meant that the exchange rates of the advanced market economies fell. But by the same token, that means that the exchange rates of the other emerging market countries, who are getting bigger and bigger and more important, their rates should have been going up. But their response was, if you guys can print the money to get your exchange rates to go down, well, we can print the money to prevent our exchange rate from going up. And it's precisely what they did. And so you had huge amounts of intervention, okay, in the buildup of all these foreign exchange reserves. You had monetary policies that were significantly easier than they would otherwise be, against the background of the advanced market economy already doing this. And in the end, you had this massive increase in global liquidity, which led to all of these imbalances and the increases in asset prices and whatever, and the leveraging and, okay? So, in a way, if the international monetary system had forced people to behave, it had rules that people had to obey, having to do with your deficits are too big or and more importantly, your surpluses are too large, then people would not have been able to get away with what they got away with. And I think we wouldn't be in the situation in which we find ourselves. So you can point at all sorts of things that went wrong with respect to the regulators that were, that missed a lot and were generally too easy, looking in the wrong direction. You can look at greedy bankers, you can look at foolish borrowers, you can look at central bankers who were excessive. But there was something in addition that was wrong with the system as a whole. And I think that's an issue that really needs to be addressed. But again, as with the regulatory stuff, the problem is getting people to accept the rules. And unless, it's not, what's the word? Maybe it's not surprising that it took the Great Depression and World War II together to provide enough incentives to get all of the people to get around the table at Bretton Woods and do something. I hope that we won't need an equally unpleasant set of triggers to do the same thing again today. But it's going to be very hard because the principal debtor at the moment is the United States, which is still the hegemon, so pretty hard to put pressure on Uncle Sam. And of course, for the IMF or anybody else to put pressure on the creditors when they've got all the money, that's pretty difficult too. So there's got to be an analytical recognition of the fact that it is better for all of us in the longer run to have a functioning system than to have an unsystem. But to make that analytical leap, it's like the old paradigm shift, and Thomas Kuhn and that stuff. Not easy to do that. So we have to settle, I fear, for second best sources like, capital controls and macroprudential instruments and that kind of stuff. Absence of willingness to get in there and try to change the system.
Bill, I think we'll stop there. I'd love to talk to you for another 2 hours, but I think you really covered the waterfront in a very, very thoughtful, very clear way. I'm very grateful to you.